next, we will be hearing from one of our platform partners, Clearco, which was formerly Clear Bank. They have been a wonderful partner throughout our summit series this year. And this session is going to be focused on when to raise VC and when to look elsewhere. This session will be led by Riley Finch. He's the Venture Capital Partnerships Lead of Clearbank. Riley, are you here?
I am. I'm here. And,
awesome, Riley. Awesome. All right. I will let you take it away.
Awesome. Well, thanks everyone for joining. I'm excited to kick things off. Gotham and Jason, are you guys here? Sweet. Yep. Awesome. Well, thanks everyone for taking the time to jump on and kind of spend some time just thinking about, what consumer in venture capital looks like. And if you're a consumer VC or a consumer founder or leading a consumer company, how people who are really smart in the space like Gotham and Jason are thinking about things, and maybe some sage advice from them as well. So would love to kind of kick things off by just getting everyone acquainted with both of you and hearing a little bit about, what you're working on now and a little bit of your background. Jason, I'll let you kick things off and then kick it over to Gotham.
Awesome. Hi, everyone. I'm Jason Garcia. I'm co-founder of a company called Intro. I started building this out as an EIR at NDVC. Intro itself is basically a software platform that companies can come in. They give a little bit of data about their business. Could be, sales data or inventory or what your financial profile looks like as a business. And then the software actually reads and kind of diagnoses and says, hey, these are the different capital forms that might fit your business. And so we help companies find good financial partners like Clearco or inventory lenders or other types of debt products. And everything in Intro itself is non-dilutive. So no equity and no VC inside that platform today.
Awesome. Riley, shall I jump in?
Yeah, that'd be awesome.
So great to be with everyone. My name is Gautam Gupta. I started my career as a VC and then made the decision to leave to start a company called NatureBox, which is a multi-channel brand of snack food. Little did I know how difficult the life of a founder entrepreneur is, especially one building a D2C brand. So have great respect for everyone here that's building a company. We got the business up to about $50 million of revenue, lots of ups and downs, more downs than ups, but we finally got the business to cash flow positive in 2018, and I was able to hire a new CEO, take some time off, and really made the decision to go back into venture investing, where I felt like I could just be a better partner for entrepreneurs and CEOs, having been a CEO myself. And so that's what I've been doing for the last couple of years. I was with a firm called M13, which has made a number of direct-to-consumer investments, and then just recently moved to a firm called TCV, Technology Crossover Ventures, which was an early investor in Dollar Shave Club, and overseeing our consumer investments for a new fund that we're going to be launching here.
Awesome. Thanks so much for that. And then for myself, my name is Riley, as Michelle mentioned, kind of at the top here, and I run VC partnerships at Clearco, formerly Clearbank. We just raised our Series C at a $2 billion valuation, which we're super excited about. To date, we've invested in around 4,000 consumer companies, deployed around 1.5 billion in capital, and want to be a great partner to everyone building a consumer brand and everything that comes along with that. So whether that's connecting companies with venture capital firms, whether that's working with companies with partners that they might use with data-driven recommendations or platforms like Intro, all of that stuff is super exciting for us. Wanted to kind of just jump into it in no particular order and get an idea to kind of set the stage. What's the state of kind of the venture mindset from an investor perspective in consumer brands right now? And how has consumer investing shifted from, let's say, like 4 or 5 years ago when we saw companies like Casper, Warby Parker, Away, Allbirds? Is there a lot of the same? Have things changed over a while? And what's your take on that?
I'm happy to jump in and kind of start us off. My perspective is I feel like every 6 months, 6 to 12 months, consumer CPG investing goes through ups and downs. Every 6 to 12 months, it's like the best time to raise capital, venture capital for a D2C brand, or the worst time. And there's basically nothing in between. And we kind of went through that process at NatureBox, where one of our rounds, it was incredibly hot time to be a direct-to-consumer brand. And then the next round, no one wanted to touch a direct-to-consumer brand. I think today there's a lot of emphasis on unique product. So is the product strategy and the actual product itself something that you just can't find anywhere else? I think starting something like a Casper, no disrespect to Casper, but just, the fact that there's, hundreds of mattress companies now, it would be really hard, I think, to get funded for a business like that. So a lot of emphasis on unique product. And then I think a lot of emphasis on a unique distribution or customer acquisition strategy that allows you to, somehow beat the, Facebook, Google sort of trap, right? Of, putting all your venture money into, trying to acquire customers off of Facebook and Google. So my perspective is there's definitely still money out there to invest in direct-to-consumer brands. But I think you just have to really convince people that you've got a unique approach on those two fronts.
And then Jason, question for you as well. Through platforms like Intro and IndieVC, have you guys seen some of the same trends and some of the same things, or have the companies that you've been working with looking at something different, and how does that kind of stack up?
Yeah, no, absolutely. I think one of the things that we see quite a bit is, obviously there's kind of naturally a capital constraint in a lot of D2C companies and needing inventory and needing to scale up. And so they're all looking for different types of funding sources. I think what was really interesting is we started launching this business right around the beginning of COVID, and we saw a massive acceleration for a lot of the D2C companies that we were tracking or looking at. And a lot of that was just the forced adoption and the decrease in retail foot traffic. And we at IndieVC obviously partnered, and IndieVC itself and OATV is a venture firm. And so we were looking at investments there and really hearing from a lot of our partner VCs that they had a lot more interest in looking at D2C companies just because of the pop or the increase in kind of e-commerce traffic and purchasing behavior that was happening. I think, still super bullish on the idea that D2C companies can access equity. In a previous life, I helped run one of the offices for Silicon Valley Bank, and focused, one of my focuses was on consumer companies, and remember how difficult it was for a lot of founders to kind of convince VCs to believe in their vision and what they were kind of building out. I don't think it's quite as hard as it used to be. But I do think that, the capital intensive aspect to an inventory business still requires you to kind of think thoughtfully around how do you blend VC with other types of capital to scale your business.
Yeah, that's super interesting. And I think one of the questions that I get a lot from founders especially is, when they're raising venture, there's so many resources out there for, a SaaS company or a fintech company, or, a company that's gone through YC trying to go and raise their first or fifth round or whatever it is. Where do consumers founders have to differentiate from maybe, let's say, like a typical, vertical SaaS company when they're fundraising? Is it something where they're positioning themselves differently? Is it just a different point in time in the life cycle of the company? And is there something that founders can kind of look to for whether it's a resource or just kind of key highlights?
Yeah, well, I mean, I think the bar is definitely higher for consumer founders. I'm sure, everyone participating today it gets frustrated when they see the headlines of, some SaaS company with $1 million of revenue able to raise at some crazy valuation. So I think the bar is definitely higher for consumer companies in terms of showing demonstrated traction, showing that consumers resonate with the product and the brand. And then I would say from a team perspective, the one thing that I know we look for in these businesses are that the team understands, the sort of supply chain side of the business. Obviously, when you're dealing with just technology, that's, just software, like that's not as much of a concern. Here, real money is going to go to buying inventory and be tied up in working capital, to Jason's point, right, around kind of sort of uses of capital here. And so just having a team that has experience, scaling something like this and scaling physical operations is really important in my view.
Yeah, I think differentiating on your customer acquisition, I think, is also important to understand how your customer acquisition works and how you're going to continue to do that in the future. There's quite a few consumer companies I've worked with in the past where the Facebook algorithm changes or some customer acquisition strategy has changed and it really flips the company upside down. And so I think, the traction in a SaaS company, a lot of times it's dollars. We're at $1 million in traction. I think there's an emphasis around how many dollars are coming from what specific channels and how repeatable is that? Or are you early on TikTok and you're seeing an increase in that channel? And how does that play out over time? So I think customer acquisition definitely plays into decision making and getting people to kind of believe that you can scale this into the future.
And maybe we could double click on the customer acquisition piece, because I know that that's a question I get a lot as well when we're helping founders try to make intros to venture firms or whatever that might be. Things change all the time, whether it's an iOS or Facebook algorithm change, like you mentioned, Jason. How much do those customer acquisition trends play into potential investment when you're looking at different channels? And have you seen anything recently that's been a super large red flag, or a company that's dealt with it particularly well?
Yeah, I think those things play into the financing considerations quite a bit. I think if every customer, like if there's no organic pull of consumers coming to the website and buying the product, there's no referral word of mouth, like it's going to be a really tough sell, I think, to raise capital. Luckily, I think most brands, and most founders are very focused on building a product that, has that organic pull through. So it's not an issue that I see that often, but you definitely see times where maybe a brand is overspending on a paid channel, has yet to really diversify paid channels. Those are kind of some of the more common issues, right? Is maybe a business is just too dependent on paid or too dependent on one specific channel.
Awesome. And then, one thing I'd love to dive into as well here and maybe change gears a little bit. I think one of the things we see is that a lot of people want to raise a venture round and they don't necessarily, understand what that means. And the idea is, I'm going to go raise $1 million and I'm going to get the TechCrunch article and do a big PR thing and get to say that I'm a venture-backed founder. Given the context of Clearco being an alternative to venture for a lot of founders looking at marketing or inventory spend, and platforms like Intro connecting founders with the right type of capital, whether that be revenue-based financing, venture debt, venture capital, and everything in between. What are some of the things that you might say, hey, if you're a consumer company, you should really consider raising? Or what are the reasons that a company might be raising for the wrong reason?
Yeah, I mean, the guidance that we typically give when inventory or D2C companies are really kind of looking for some kind of investment is to really try to understand why you have a capital constraint, but why do you have a capital constraint? And if that reason around why you need capital is something that you don't expect to pay back in 6 to 12 months, it might be a better fit for something with an equity partner, whether that's a VC or even smaller, the angel investor or somebody else to come in. Because if you do have some need in your business, but it's fairly repeatable, I want to invest more in customer acquisition. I know in the channels that I invest, I spend every dollar, how many dollars come back. If you've got that predictability in your revenue generating side of your business, it might not make as much sense to take equity, depending on how many dollars you're trying to deploy. Same with the inventory. If it's you're trying to build up more inventory so you can sell through, but you have a pretty good idea of how your inventory turns and how quickly you sell through it, you might not need to go through kind of the VC route. I think the other, what always remains true in kind of looking for an equity partner is also the level of return that you expect to get back. If you're planning to invest to bring a part of your supply chain in-house and become more vertically integrated, and there's a step function to your business to that, you can unlock a next layer of growth or a next layer of profitability or margin in your business, absolutely makes sense to go and talk with a VC, and they can fund that longer term kind of project. But if it's short term and it's something repeatable, I would be looking to alternatives rather than VC.
Cool. That's awesome. And then, diving even a little deeper into that, with consumer companies and venture firms, a lot of the times we're seeing venture firms looking for their fund returner, with an expectation that this company is going to be, minimum $1 billion company and everyone's going to be super rich and it's going to be great. Is there room for lots of consumer companies in a similar space that are smaller? Is there room for companies that are building something that's making an impact and making a change, but might not be the next, let's call it Warby Parker? And how can founders think about scale and size in a venture perspective?
Yeah, I think this is one of the real big challenges and issues when thinking about funding direct-to-consumer brands as a venture firm. And I think as a founder, the way to think about this is the size of the fund that invests in you is really going to determine how big of an outcome they need to have in order for this to sort of be a successful investment. And as you get into these $1 billion+ funds, it's really hard to move the needle in a fund that big by creating a brand, that could have tremendous impact in the world and could be a huge success for the founder, but may fall just shy, right, of getting to the size that is a fund returner, right, to sort of use the words that you mentioned. And so I think a lot of it comes down to like picking your partners very intelligently and very thoughtfully, and picking, the VCs who understand, how to build a brand and are aligned on what the outcomes look like in this space. And that's, in my view, that's just a smaller segment of the venture world, who have the right fund strategy to enable, them to be the right partners here.
Yeah, and just a real quick plug, because this kind of sits to the core thesis of Intro and some of the core thesis of Indie. When I was really, we talked about Casper. I had worked with Purple pretty early on when they were just launching, and was a lender and helped them kind of scale up. And they had a great outsized return. They didn't take on any equity partners. It was all either self-funded or funded through debt. And there's a lot of those kind of opportunities out there that you don't have to be a $1 billion+ outcome to have a successful business and to be a successful founder. There definitely, there's advantages if your business has that need and it can consume that capital and really grow quickly. Then by all means, take advantage of it. But equity is not always the solution, nor is the TechCrunch headline the solution either. I think you can build a great business and have a really successful outcome for yourself, whether that outcome is selling it or building a fantastic business and handing it on to the kind of the next generation of operators to take over. It's not binary, and do you raise VC in your success or not. There's plenty of shades of success here.
And maybe here's a question as well. For a company that is super aspirationally trying to be that next, marquee consumer brand and, really change how people are thinking about whatever product in the space, but aren't quite at a place where taking on equity dollars makes a lot of sense, what advice might you have to that founder?
Yeah, I mean, I think so much of the business probably at that stage is about just being creative around how to solve problems. From an equity standpoint, if it's not the right fit or stage for venture money, is it the right thing for sort of friends and family or family offices, or things like Clearco, the right fit at that stage. I think the other thing that a lot of entrepreneurs probably don't spend enough time on in these businesses is thinking about the working capital cycle. And so, look, if you can get to 90-day terms with your co-packer, that just does wonders for the business, right? And just reduces your capital requirement. And a lot of those things, if you solve early into the life of the business, pay huge dividends as you scale. So I think, there's probably no one solution there. It's really probably business dependent, but some of the things that folks should be thinking about.
Awesome. And then maybe tying into that as well, question for you, Jason. There's so many new products that aim to kind of help companies manage their working capital or their spend or whatever that might be, whether it's like a Brex or a Ramp or a Clearco or anything in between. As a founder, how do you evaluate, those different options to make sure you're choosing the right one, the right fit for your business?
Yeah, it can be kind of confusing, especially I think the way that a lot of these products are marketed. I think the point would be to try to get down to what would be your annual cost per one of these products to kind of gauge what the economics are between the two. And so, the cost is always going to be pretty important when you're kind of looking at them. But I would say more importantly, I would be looking at how do you use this, or what is the flexibility on use for this? An example is talking about Brex, right? Brex being a credit card, there's going to be some things that you can purchase through that, and they're going to have an understanding of your business and approach your business in a certain way. Clearco is going to approach it in a totally different way. You might deploy it in different areas too. You might want to have an inventory lender who's going to pay your supplier directly and manage some of that cycle for you, take off some headaches. And you might want to deploy another type of financing directly on your customer acquisition channel. And so one way to think about it is a lot of times they're not competitive one with another, they're complementary. Try to understand how you can deploy them and how you can build a financial stack inside your business rather than just trying to take one type of capital and deploy it across all the needs that you have in your business. So definitely cost and then use of funds. How can you use those funds in your business?
Yeah, that's awesome. And I think that's kind of echoes one of the biggest common mistakes that we see broadly at Clearco, which is folks coming in and it's super binary. It's I'm going to raise venture or take a huge term loan, and there's nothing in between. And there, in reality, there's tons of things. And you mentioned kind of building your capital stack is hugely important. And whether it's doing research on your own or talking to someone like Intro and being able to build that out piece by piece is super awesome. We've only got 4 or 5 minutes left here. So I want to encourage anyone who has Q&As to post them down below. And while they do, I'll ask one last question to the both of you while those Q&As trickle in. So the question would be, what is the best kind of piece of advice you would have to a consumer founder looking to go and raise venture? And then conversely, what's the biggest mistake you see people trying to raise venture as a consumer company make?
Yeah, I mean, my probably biggest piece of advice would be to really, be thoughtful about the process. Everything from the number of firms that you go out to, the person at each individual firm that you talk to. Just be really thoughtful in the process. I think often we, as entrepreneurs, we can get kind of caught up in the news of there's so much capital out there and it must be so easy. Money's just going to rain down on me. And, I think the reality is these things are highly orchestrated processes. So that's probably, my piece of advice. And then, biggest mistake, I would say probably just not being solid enough on unit economics and being able to explain, things like gross margin, working capital requirements, things like that. Those are some of the things that investors are going to want to understand in order to get a feel for how much capital it's going to take to get the business to profitability.
Yeah, I would just echo the data side of it. I mean, I think, naturally, because you have so many parts to your business, you have a lot of data to really kind of tell the story. And that data can be your friend and be a strength if you use it the right way. Make sure that you're collecting it, you're organizing it in the right way to tell the story, versus just painting a vision or a picture, because you've got maybe more than some software companies have to kind of pitch and validate the way that you're looking at your business and the opportunity going forward.
Awesome. Thanks so much, guys. That's killer. So 2 quick questions here I can see kind of trickled in. One is, how does a bank or lender qualify a startup when raising debt capital for working capital, e.g. Open Door, Zero Down, SoFi, Ethic? Either of you want to take a stab at that one?
Sure. I mean, it really kind of depends on the type of financier and what they're trying to finance inside. Banks specifically, they're going to care about a few things. How strong is your balance sheet? How much cash do you have? How many assets do you have? What does your inventory look like? The banks are going to be the more conservative of the lenders that are kind of playing in the space. And, me being one of them historically used to do that. And I will tell you that they are very conservative in how they deploy capital into, especially D2C companies. I think they're getting better, but really kind of what they're looking for is, do you have the ability to pay back this loan if something were to happen? If your company were to shut down overnight for whatever reason, do you have the cash or do you have the inventory to be able to pay it back? And the other side of it is, if you're raising venture capital on the equity side, that can be a strength in convincing a lot of lenders to kind of come in, because if you've got a great capital partner that a bank trusts and knows, it might give them the confidence to be able to kind of put some capital into your business as well. So on the bank side, that's definitely what they're looking for. On the non-bank side, they get hyper focused and kind of understand specific aspects of your business, and that allows them to get comfort to give you capital and still feel comfortable that you're going to be able to pay it back. Clearco being a great example of that, in that you guys probably understand return on ad spend better than anyone else in the market, and different aspects of a business. And so be able to quantify and say, man, I can get really comfortable with how your business is running and how your revenue is kind of coming through the doors, to be able to get comfortable with giving you some kind of financing. Bank more conservative. It's going to be a lot more based on your balance sheet. And then the non-banks are going to be looking at how your business runs to get comfort.
Awesome. And then we've got one more here. How do you get funding if you're a pre-revenue, but have a prototype or the start of a very unique product?
Yeah, maybe I'll just kind of quickly chime in. I think, look, that's definitely one of the toughest stages to get financing. I would, think about kind of all the creative sources around, revenue-based financing. Could you get a customer to, give you a PO up front? Could you get friends and family, or maybe someone that's been successful in the space that you're operating in to invest? And I would just think about, how do you get to traction on as little capital as possible? And look, traction doesn't necessarily need to be revenue. It could be like product, not just a prototype, but a fully finished product, branding done, all of those things. So I think it is a really tough stage to raise capital for, and it's just about getting really creative.
Awesome. And then for everyone listening as well, just a quick plug, Clearco, the way we work is completely data driven. You can head to clear.co, connect your different business accounts, whether it's your Facebook and your Google or your Shopify and your Stripe. And then in just a few minutes, we'll be able to generate offers in a super transparent way that you can potentially use to grow your business. So would highly encourage that. No upfront commitments, and always happy to see new faces in the door. Michelle, thanks so much for having us, and Gotham and Jason, this has been awesome. So thanks so much for joining.
It was awesome, by the way. Thank you so much for the incredible partnership. I mean, a theme that we keep talking about is having great partners. You guys have certainly been that. For those of you listening, on foundermade.com, there is a Clearco just program that we've set up in partnership with the team here to get you financing. If you haven't already explored this path, you can go and test and get that kind of feedback and see what you might be eligible for. And if you just go to foundermade.com, it is at the top bar. Or if you type into your navigation, clear.co/partners/foundermade. And if our team who's operating in the background and making sure this runs smoothly, if you guys can throw that even into our chat for people listening in who are interested in exploring this, click the link, throw your information in there. It takes 2 seconds to run through and set up your accounts, but it's, you might as well, you did sit in and explore this, and it's great to just know what kind of options you have available. So throw it in there.